Go ahead and get this recording started. For those of us who weren't able to attend, we'll get a recording. But again, thank you all for joining live. We'd love to have everybody live. We're going to go ahead and get started. It is 10:03. Today is July 9th, Thursday. Going to be doing a review. Let me get my keyboard over here of the first half of 2026. We are halfway through the year. I feel like sometimes I'm in a time machine because I end up doing these quarterly reviews, half year reviews, full year reviews so quickly. Life is just moving along, and the year is moving along pretty quickly. So again, thank you all for joining. My name is Brian Nicolason, host of today's webinar, also the founder CEO of Nicolason Wealth Partners, which is in partnership with Brookwood Investment Group, and really just want to shout out the team over at Brookwood. They've been incredible this quarter. We've worked really hard to do as much research as possible, as I noted in my email. Okay, we're going to jump right in. We are going to talk probably about some things today. Not as many charts, maybe. We're going to talk about some concepts and some of our outlook. And we're also going to spend some time at the end on some individual companies, as we normally do. In these webinars and podcasts, we always like to host or highlight an individual company. So we're going to do that at the end. So 2026 we're going to call this assessing the damage, because definitely some damage has been done to the bull case. Let's see here. So half one has damaged the bull case. The earnings are very cyclical, and we've got the Fed reversal. A lot of that has to do with the war in Iran. So the Fed reversal, meaning, we were in an easing cycle. We were lowering interest rates. Remember 2022, midway through 2023, we raised interest rates 5%. And that was a reaction to the inflation shock that we got following the COVID recovery, which we'll call that a supply shock, demand shock as well. But basically, we had these really high prices, 9-10% inflation. My assessment was more like 20% inflation. But we had this big inflation, and sorry, I just wanted to make sure I was recording before we get too deep into this. And let me actually make sure. Yeah. All right. Hopefully everybody can hear me. All right. So I'm going to have my phone up as well, just in case any of you who can't hear me, or if there's an issue, please just text me if you got my cell phone. All right. So in any event, the Fed reversal we're in this easing cycle. So sorry, back to this. So we're raising interest rates 2022, 2023. We raised, 5%. And then 2024, 2025, we were starting to reduce interest rates. Inflation had come off its high of 9% back down to 3.5. And we were hoping for another 3 rate cuts this year in 2026. And that has stopped. We are now in a pause cycle. The easing has stopped. And that's a result of the war in Iran, right? The war in Iran pushed oil prices up, and it pushed up inflation expectations. And the Fed reacted promptly to that by saying, hey, okay, we're not going to cut interest rates. So that's been a real problem. Again, plus the volatility in the overall market because of the war and oil prices. So between that Fed reversal, the high inflation expectations, the high oil prices, that volatility, and a very cyclical earnings picture, we've seen multiples come in on the market. And that's why we saw the correction back in March, April. And again, the market has been struggling all year, essentially. That has definitely damaged our bull case. Part of that is concern around AI. We think that's a little bit overblown. So the result, even though there's been some damage to the bull case, our belief is that without Fed hikes, which we're not getting yet, like I said, we're just not getting cuts. But as long as they're not hiking, we think the bull market should stay on track. Okay. The trouble with writing an outlook is that it has to make sense, and real life does not. Okay, so this has been a difficult quarter, as I've kind of mentioned a couple times to folks, and that understanding what's going on in the economy and the market has been difficult. It's been foggy. And a lot of that has to do with the war in Iran and the volatility that that's created. Predictions are always difficult, right? If we're going to try and assess what the back half of this year, the next 3 years look like, that's always difficult. But now we've got a series of unknown unknowns, right? So there's always unknowns. There's known unknowns. One of those being, okay, what's the jobs number going to be this month? Well, we don't know, but we know that we don't know, right? This quarter, we've got unknown unknowns. Like, who knew that we were going to be asking the question of, hey, is the fourth ceasefire in a hot war with Iran going to hold? Apparently, it hasn't. So that was an unknown, like whether or not that ceasefire was going to hold. I didn't even know that that was going to be a question at the beginning of the year because I didn't even know we were going to be in a war with Iran, right? So these things were so unpredictable, I think. That's what's these black swan events. I mean, this has been the story of the last quarter. It's been the story of 2026. It's been a tough year to predict and understand. And that's why a framework is superior to predictions. We are not here to make predictions. We're not here to make bets based on feelings. We have a framework. Our framework guides our investment thesis. That framework is fairly simple. We invest in individual equities that have shown a proven track record of growing earnings 10 to 20% a year. If that happens, if we invest in companies that grow their earnings 10 to 20%, they have a track record of it, and we believe that going forward they can continue to follow that track record, then our portfolio of equities should go up 10 to 20% a year. That is the framework for individual asset allocation. And then beyond that, we have a framework for risk management, which is utilizing the 200-day moving average to make sure that when the markets do implode from black swan events, which are here all the time nowadays, that our clients don't lose significant amounts of money because they are in a retirement planning stage of their life. So the framework of how we invest is the most important. And it's far superior to the predictions. And we're going to talk about that framework today, about how that framework works. Okay, if we're looking for companies that have proven track records of growing their earnings at 10 to 20%, we believe that the future holds opportunity for them to continue that process, then that's going to inform how we're asset allocated this year, and it's going to inform a little bit about the results for the quarter and the year to date. So we'll talk and come back to that framework. But anyway, as we say, framework's better than predictions, but let's make some predictions anyway, because that's what we're here to do today. All right. Before we go into all that, talk about some year-to-date results, 2026. Year-to-date, our moderate aggressive portfolio, our 70-30 portfolio is up 4.09%. The benchmark S&P 500 BND 70-30 is up 6.29. Now, that does include dividends and interest on the S&P. You can see we are having a slight underperformance year-to-date. And again, it's going to go back to our framework, and we're going to touch on this a few times today's webinar. But I do want to highlight the last 9 days, we have outperformed the market, the benchmark, by over 1% just in 9 days. So the tides are turning. We think that this, slight underperformance we've seen so far year to date is the result of some very specific things that happened. Again, we'll touch on them, but we do think that tide is changing, and our steady hand and our framework is what's going to give us that. We think at the end of the year, the outperformance. If you look back 2025 and 2026, so that's a year and a half now, we are outperforming that benchmark by 3%. If you look back 24, 25, and part of 26, we're outperforming by over 4%. So we've still got significant outperformance the last couple of years. Again, this first part of the year, we're lagging just a little bit. And again, that's based on our framework, which is probably a little bit more conservative than the very momentum-based market we've seen the last 3 months. But again, that tide is changing. So just want to touch on that quickly. And again, we're going to be meeting with all the clients for the Zoom Q1 meeting starting the 20th, whatever that date was, because next week I am on vacation. But the week after that, we'll begin those meetings. We'll talk about individual accounts at that point. But again, just big picture, very proud of the work we've done the last couple of years. To be beating the S&P 500, that is reserved for a very small category of asset managers because the S&P 500 has been such a dominant index. And to make sure we're beating that, I think is a high bar we've set for ourselves, and really the only bar that we should be striving for. So, all right, let's review our predictions. So Goldilocks, that was our prediction. We felt that there was enough weakness in the labor market that would support an easing process. So that began in 24 and 25. We started to see that easing, those rate cuts. And at the same time, the weakness in the labor market was not too significant where we would see a recession. So this kind of Goldilocks scenario, not too hot, not too cold, but just right, well, that was in play. And that was our prediction that would happen, that would continue in 2026. Again, a combination of preset disinflation. So we were seeing labor cooling. We were seeing some disinflation just naturally off the very high inflation numbers from the COVID cycle. So again, there's a lot of the embedded components of CPI were coming down. That was basically preset to happen. And then there was this big earnings boom. So it was Goldilocks. I mean, it was very bullish. And that's why we had a great year last year. That's why we had a great year the year before. And we felt that probably should continue this year. We still do think it is, but the Iran war, the closure of the Strait of Hormuz, it upended that disinflationary part of the story, which upended the Fed easing cycle, right? So we've now lost that easing part of it. We still have the earnings boom, but that's actually a bit concentrated. So there's some holes there too, but we still have that earnings boom. But we don't necessarily have that preset disinflation. The question is, well, go back to that. But the question is, how impactful is that oil price spike on the overall disinflationary picture that we've been in? And that's the open question. Again, even though we're not easing anymore, we're not lowering rates anymore, the market is hoping that the Fed will look through. Now, the third supply shock in 5 years, we had COVID, we had the tariffs, and now we have the Strait of Hormuz. We've got these supply shocks that keep coming in. The market, again, is continuing to hope that the Fed can look through that. But now we've got a whole new Fed chair. We've got Kevin Warsh, who by the way, historically was a hawk. I mean, he didn't even want to see bailouts in 08 back then. And that turned out to be, again, we can argue on that, but it turned out to be, at least, let's say, it didn't turn out to be inflationary. So it helped stabilize things, and it did not end up being an inflationary event. So, again, so I guess you would say he was wrong on that, but he didn't want to do that. He didn't want any bailouts. He was a fiscal hawk. And then he'd been that way 90% of his career until he wanted this job. And then he became a dove. So we don't even know who he is, right? We don't really know what his story is. He's a bit of a chameleon, and so a political chameleon. So we'll have to see what he does. All right. But so a lot of big questions, but overall, at a high level, the Goldilocks prediction was right. The yields made a low, a 5-year low, or back to 21. So yeah, 4.5-year low right before the war began. And again, as we project out, the question is, how much damage did that war and the oil price spike do to our Goldilocks scenario? Again, we still have that earnings boom, and we still think we have the investment cycle of a lifetime over the next 10 years. However, we don't necessarily have that disinflation, and we don't really know how the Fed is going to react. So those are the big questions. Parallel to these monetary questions, right, as far as, how's the Fed going to react and what's going to go on with inflation, what's going to go on with interest rates, and how does that affect equity prices and equity multiples, we also have this AI thesis. Again, I just talked about it as a investment cycle of a lifetime, but there's a big question about, what does that look like? And it's going to continue to drive the capital markets. Semiconductors have accounted for 71% of the S&P 500 year-to-date return, even though they're only 18% of its market cap. They've accounted for 78% of the 1.38% margin expansion. So margins are growing in the S&P, yet semis account for 78% of that. They're only 18% of the market. They've also accounted for 50% of the forward earnings estimates increases year to date. So semiconductors are driving everything right now. And that's the AI CapEx build out, which we're going to talk a lot about today. But that is really a big focus of ours because what does that mean? Right? Yeah, we've got an earnings boom. Yeah, the markets look good, but it's this tiny part of the market that's doing all the heavy lifting. And with the backdrop of all these monetary questions, it does poke some holes in our bull case, and we have to be aware that that's going on. So let's tangle everything together, right? So this CapEx boom, this spend to build out data centers for AI usage is making the economy look more resilient. It's making the economy grow 2, 3%, maybe 5% nominal growth. A huge portion of that growth is coming from this CapEx spend. So it's also keeping the Fed from responding more directly to the rate sensitive consumer sectors like housing. So we've got consumers struggling, especially consumers trying to buy houses. Housing related services are going up. Anybody in the housing services market, think mortgage broker, has had a significant slowdown because resale volume is way down. So the housing market, which is overall a huge part of the overall economy, is really struggling. And the Fed likely should be easing to soften the burden there because it's very impactful on consumer sentiment. And yet they're not, because they've got this huge CapEx boom and all the numbers look really good. Meanwhile, it's really just, a very small part of the market that's benefiting. So in short, the AI boom is raising economic growth, and it's also part of the reason that the easing cycle has ended. And again, this is all tied together. The AI evolution and this Fed policy shift from an easing cycle to a, let's call it pause, but potentially tightening, is going to define the second half of 26 and into 2027. So these are the big factors that we're looking at as we go forward. Equity sentiment is mixed. The purple line, the blue line, purple line's the equity market, and the blue line is year-end strategists forecast. And you can see basically they're forecasting kind of right where we are. They're not looking for significant growth. And so, again, we've got this meh outlook on equities. It's been a ton of volatility. Are they going to grow through the end of the year? Strategists are mixed on that again, and then a lot of that's because the earnings growth is all coming from this CapEx boom and AI cycle. So again, this is all just the stuff that we have to look at to understand, what's the outlook look like. Now, again, earnings estimates are up 18% year to date. That's crazy. It's the second best ever historically back to 1990. So we've never seen a first half where earnings estimates were up 18%, but for one time. And, but again, over 50% of that increase is the semiconductor industry. By the way, these are the earnings estimates going forward, and you can see that they're front-ending a lot of this earnings estimate growth. Like they're looking for 23% year-over-year earnings growth this year. But you can see then it tails off. So this really coincides with this AI build-out. And what it speaks to is the inconsistency of the companies that are benefiting right now. It speaks to also why our framework has kept us out of some of these super high growth parts of the semiconductor industry because they don't have that consistency. They don't have that track record of earnings growth. They're seeing maybe this short-term spike for 1 year of earnings. But again, after this first year, we really don't know what's on the other side of that. And if it goes back to the standard of the semiconductor memory cycle as an example, it doesn't look that good because it's very cyclical and it's not very consistent. And that's why those companies are punished most of the time, but for this year. So again, Our framework is we want consistent companies, growing earnings 10 to 20% every year for many years, because this proves that that company is stable in an environment that's anything but. So again, want to move on. We're going to walk through this bit by bit. I know there's a lot of content here, but it is important to understand how we as an asset management company are looking at both, Fed policy, how we're looking at individual equities, and how we're looking at the macro, right? So we do look at labor. These are very interesting charts to me. The top chart is the college educated wage growth. So if you're a college educated person, only your wage growth is down significantly. So back in 2024, it was like 6% wage growth. Today it's under 3.5. So wage growth is falling off the face of the earth. And the percent of workers without a raise is now up to 13%. So we're seeing a significant rise in labor weakness, especially for the college educated. This is concerning. This is the labor weakness that I've been talking about that is absolutely going to start to filter in to the overall economy and consumer sentiment. I think it already has. We look at jobs plentiful minus jobs hard to get. So that's rising. You see that purple line? That's rising because more, and this is an inverted graph to go along with the unemployment rate, which is blue. But given that the jobs are harder and harder to find, we think that purports probably a rise in unemployment is ahead of us. So again, there's labor market weakness. There are large swaths of the economy that are being negatively impacted by this very narrow market that is very narrow economy, right? The growth is in CapEx and AI. I mean, unless you're building data centers, which, unless you live in like Louisiana or something, you're not likely to be building data centers. You'd have to live in one of those towns. So the overwhelming majority of Americans that aren't building data centers really just don't have that, the growth that the Fed is seeing. The wages are stagnating. And so they're losing purchasing power because we're seeing inflation every year. So there is weakness. There's underlying weakness, and it underpins some of the holes that we're seeing in our bull case, in our Goldilocks bull case. Housing starts are collapsing. Now, I could have predicted this. I just did a renovation on my house. It's been so expensive. I mean, everything you do, it's like box of nails, $180. You know, uh, I don't even know the prices because I don't even look. But I know it's incredible. Like the numbers are just staggering and they add up so quickly that I understand why they're not building houses because it is so darn expensive to do it and people can't buy. They can't buy at these prices. So housing starts are collapsing. Single family, multifamily, they're starting to contract. And they've been building a lot of houses because there's no resale, but now even the housing starts are collapsing. And we think that that's going to affect the overall consumer. So the question is, right, we lay this thing out, we lay this story out, you've got an inflationary backdrop, which is always concerning. You've got wage growth stagnating, so you have overall the everyday American is losing purchasing power. The housing market is totally screwed up. The resale market is all frozen because of the interest rate differential. And now housing starts are collapsing because they're so darn expensive to build that people are just giving up on that idea. More and more people are renting. So you've got consumers and jobs are harder and harder to find, especially if you're coming right out of college. So you've got young consumers hurting. You've got the everyday middle swath of America really feeling the rising prices. And the only thing we've got going for us is AI. And so the question is AI an economic savior? And I don't know. This is a tough one, right? 100% of job growth in the last 12 months has come from government, healthcare, and education, right? That just goes to show you that the private sector is struggling. No doubt about it. And by the way, it's been happening for many, many years. Wage growth is dropping. We just showed you on the chart there. Housing market sinking deeper into the doldrums, right? Residential construction payrolls down 2%. Based on our units under construction calculation, there's a 9% surplus of residential construction laborers. So we're thinking we're going to see more unemployment, right? Unemployment is starting to rise in all different industries, particularly in residential construction, residential labor. Yet, hyperscaler capex, right? These are these data center companies that are building data centers. Well, that's growing 2.5% of GDP. You know, 400, $500 billion a year being spent building data centers to automate workflows to remove more laborers from the market, right? And as the Fed remains hawkish, right? They're not easing anymore. Residential fixed investments at a 15-year low, and our collective economic fate, more importantly, the market's path, because I don't even know that the economic fate is even correlated to this, but the stock market's path is just tied to this AI build out. So the question is, can the AI build out save us? I think it's problematic for non-investors. If you're a non-investor, I don't think it benefits you at all. Probably, I mean, let's put it this way. You'll be benefited over the next 10 years if you stay up to speed and you start implementing AI into your small business, or if you're an employee, if your business owner is empowering you, your boss is empowering you to use these great tools, then yeah, I think maybe you benefit. But in the short term, in the next 3 years, if you're not an investor in the space, I don't see how AI is saving any bit of this economy. So the good thing is we're all investors, so we will benefit, and so great. So we could, I guess, again, for the purpose of today, let's just talk about us, right? We'll talk about the investor class because we are in a position to benefit greatly from this massive productivity gain. Be damned with the rest of them, right? It's like, but unfortunately, that's how you have to look at it if you want to understand, well, how does this affect me? Well, you're an investor, so we're going to talk about how that affects you. What I just talked about is how it affects the everyday person that doesn't really invest in any significant way. I think they're going to struggle, right? And that's going to create societal problems that we all have to deal with. But I'm not, a politician, and I'm not here to deal with any of those problems. I'm here to deal with the investments that we are putting our dollars in. So that's what we're going to talk about. So what is this landscape, right? So I've been talking now to go back to the market, right? I've been talking about this investment cycle, this AI super cycle, that it's the greatest investment theme we've seen in our lifetimes, greater than the internet, right? And I've been talking about that. So what does that landscape look like, and how are we positioned? The big changes that we're seeing on a day-to-day operational level is this frontier versus open source model. Now, that's been a conversation since 2023 when ChatGPT became the frontier model, and then Meta was the big one that had an open source program for their Llama model. So there's kind of been this conversation, but I think the conversation is coming to even more of the forefront as the frontier models have gotten very expensive as people are using these agentic systems. So now we're at a point, right? It's been 3 years now where we're starting to use agentic bots, right? These digital workers that are AI bots that are agents for us, and they perform multiple layers of tasks without prompts, right? The old one was you prompt it, it does something. Now they're able to work through and a series of things without us prompting them. And so that's where AI is really coming into its glory, and where it's really providing value for enterprises. As we're getting to that point now, the workloads are significant, right? If you're going to have an AI bot do a series of things for you, maybe on an automated basis, once in the morning and once in the afternoon, as an example, then every day, twice a day, they're doing multiple things, and it's pinging back to whatever model your system is tied to. And you're getting charged tokens. You're getting charged usage fees. And those usage fees, people are realizing, are getting incredibly expensive. They're also realizing that as they build out these unique systems, that ChatGPT, as an example, is stealing them. So if you're a company and you're using ChatGPT as your back-end large language model and you're creating all these workflow automation programs for your business, and let's say you and your engineers spend a great deal of time creating all this great stuff, it's all on the ChatGPT system. So if ChatGPT likes it, they could just take it and release it native to their own system. And you're essentially contributing to their benefit. It doesn't benefit you at all. Not only that, but you're also potentially putting all of your client data, right, your business proprietary data, into a third party, which is ChatGPT, OpenAI. And whether it's them or it's Anthropic or it's Google Gemini or whoever it is, those companies are third parties. Now, they may have privacy policies, but at the end of the day, if it's important client information, you do have to understand that that is going into these companies' hands. So what open source models allow us to do is to take models that were created and then published online. So the weights in the algorithm is published in code online. And you could take it and put it on your own computer and run the large language model directly for yourself. That way, the data doesn't go anywhere, it stays on your computer or in your server, your infrastructure. There's lots of ways to do that. But at the end of the day, it's more private, and you don't have to pay ChatGPT every time you run an inference. You are running it on your own compute. Now, again, most people's computers are not powerful to do this, so you'll still end up renting some space, renting some GPUs to run this, but you're going to pay just pure workload costs instead of paying a profit to ChatGPT. So this closed source, open source conversation is very important, and hopefully I did a good job explaining that. But at the end of the day, like I said, if you're an enterprise, do you want to give your data to a company and create AI processes for them to steal, or do you want to run it on your own model? It's also cheaper to run it yourself on an open source model. So what does it mean for the hyperscalers, right? We are big investors in Amazon, in Google, in Microsoft, some of these big hyperscalers. Well, they're going to lose that API fee. If more and more people are using the open source models and they're not going to use Anthropic through Amazon, they're not going to use ChatGPT through Microsoft or Gemini through Google, and they're going to use an open source platform, well then, hey, they're not going to get their API fee, but they're still going to get that raw compute volume. And that's the bread and butter business. So as we continue to push forward on these open source models and agentic systems and more enterprises adopt them, and it is 100% of enterprises in around the world are looking at this. And I would say 60 to 70% are trying to get it implemented. In the next 5 years, it's going to be every company in the world implementing agentic AI systems one way or another. Some at greater, capacity, some at smaller capacity, and in all different speeds. But at the end of the day, they're all going to need these systems. Some of them are going to be through the frontier models. They're going to pay the fees. Some of them are going to want to do it themselves. But either way, the hyperscalers benefit. And that is really where we land. And when you look at the open source programs, this just creates more demand for the custom silicon, another benefit to Google and AWS for their Trainium chips, their Tensor chips. As we continue to go down this path of agentic AI, again, being this like hybrid system of some frontier models, some open source, at the end of the day, it's more demand for high-powered GPUs to continue to outperform closed source models. These open source models, you have to train your own data. It's your model. You took it off the internet, but it's your model. You have to update the weightings, and you're going to need GPUs to do that. And the hyperscalers are absolutely being built to accommodate that. And we think it's very accretive to top line revenue for the cloud companies. the hyperscalers, and we think it's just a no-brainer that that's where things go, and we think that does support the CapEx cycle. Um, so again, you've got this AI build out. Hyperscalers over neo clouds. This is something that we're looking at too. Neo clouds are like CoreWeave, um, or do you go to hyperscalers? So as an example, like let's say you had a bunch of data, you're a big enterprise, and you have it all hosted on Amazon Web Service. You can use that data that's on Amazon Web Service to create your own AI system, and you could do it through Amazon. You can rent their compute to do it. Or you can try and pull the data out of Amazon Web Service and use CoreWeave or one of these neo clouds that doesn't do this data storage. They just do the AI processing, but you've got to move all your data constantly. And that is, I think, more of a barrier. So we think the hyperscalers, they do better over the neo clouds long term. I mean, neo clouds will always have their place. These are just AI factories. If you just need high speed, cheap AI processing, you could go to CoreWeave or one of these companies, and they are a direct competitor. We want to own both. CoreWeave is on our purchase list. We've been analyzing that stock for many months now, and we are going to pull the trigger on that. They've been selling off a little bit, so we've been patient. But at the end of the day, we think hyperscalers still maintain that leadership position, and that's because of the install base. They've got the data ownership, and that's important. And they've got scale, right? So we think that they'll do well. On the semiconductors, and this is very relevant to this first half of the year because we've all seen the stories. Micron, has gone up significantly. Broadcom, these are component providers, right? They provide little components that go onto the NVIDIA chips. But the NVIDIA chip and the CUDA software program, they are the architects. That is, at the end of the day, Micron sells memory blocks, Broadcom sells the controllers and the design, but NVIDIA sells the entire system, the compute, the cooling, the networking, the software. And we believe the company that sells the final aggregated machine, that GPU, is going to command a higher leverage over the value chain than the component suppliers. And so we hold a much bigger position in NVIDIA than we do in Micron. We have access to Micron through some of the ETFs that we own. We don't have this huge position in it. And we're going to talk about that company as well, again, because it's been the main story this year. But we think long term, hyperscalers and NVIDIA are in a better position than the neoclouds and the component providers. Also, last but not least, we want diversified businesses. This is a bumpy economic environment. It's a little image that AI built for me on the Google AI system. So they have 17 plus AI tools. That's just one part of the business. They have all the other businesses that Google have always had. This is a diversified business that maintains earning growth in that 20% ballpark range. And no matter what happens, they have the diversified business to deal with it versus maybe a component supplier for a semiconductor company that is going to ride a cycle like this of what's the demand for their little piece that they sell, right? There's a huge difference. And as we invest for clients that are in retirement or close to retirement. We are not going to invest in any significant way. Again, we'll own some of this stuff, but we're not here to be like momentum swing trade investors, right? It's incredibly risky. It doesn't have long-term any real value. I would rather own companies that are more consistent, more predictable. They can still be on the cutting edge, right? Like Google, but they have a diversified business that gives us the stability that we're looking for, as we invest large sums of retirement dollars in equities. So again, we think the overall outlook is cheaper open source models, customizable enterprise agentic solutions made through the hyperscalers. So we just think, Amazon Web Service, Microsoft, Azure, Google Cloud, these companies are so well positioned. They have the infrastructure, they have the diversified business, they have the cash flow, and they have the install base. The enterprises already have their data there. They're going to be the ones that are going to win here in providing access to build out the agentic AI systems that everybody needs. There'll always be the frontier models, the ChatGPTs, the Geminis, the Anthropics, and that'll be available for anybody that wants just a turnkey system, and not have to do any coding. So small businesses, they'll still use that. They'll still pay those higher fees, and that's going to be part of the overall landscape. As we get into the individual companies, we'll talk about Micron again, because again, Micron has been the story. Obviously, it is a small part of the S&P 500. It is a small company relative to some of the hyperscalers. Again, still very big company, but $37 billion company. Market cap. So yeah, 100 in millions, hundreds. Yeah, 37. Yeah, they're like $100 something billion. I don't have the updated numbers, but 100 something billion. And maybe they're larger now. They've gone up a little bit. But anyway, the point being, you look at a company like this. This has been a perennial loser. The stock has done terrible for a decade. And the reason is because their earnings is so cyclical. They sell these memory chips. It was based on the PC and smartphone demand. And as those cycles went, so did the earnings. And you could see, 147% growth, negative 49% growth, negative 55% growth, 113% growth. I mean, the growth was so cyclical, and they had been in the doldrums the last couple of years. Micron has really, really struggled to maintain any consistency earnings, and that's why they're not in our framework, right? We look for consistent companies that have a pathway forward. Micron didn't up until this year. Let's put it that way. March of this year, everything changed for Micron. And that was because NVIDIA announced a partnership with them, right? That they were going to buy those memory chips as part of their GPU, their newest GPU release. Now, by the way, and that's why their earnings exploded in March and their stock price exploded. Things have changed. We are open as investors to look at situations that changed. Micron still trades at an 86% discount to its competitors. It trades at 6.7 times forward earnings. It is incredibly cheap, and we're looking to buy it. Okay, you could see the rally here, but this was based on March, right? This happened this quarter. Things changed, and we're finally getting a bump in the earnings for Micron, and that's being reflected in the stock price. Now it's down 20% this month. So it's gotten blown up. It was definitely blown up a little bit more. We're still seeing where earnings are going to settle out. But at the end of the day, with this new partnership with NVIDIA, and we think what's ahead on the CapEx spend, we think it's a buy. Just like NVIDIA was a buy in 2023. Just because you missed the early parts of NVIDIA doesn't mean you don't buy it in 2023. I mean, it's 5x since then. We think Micron potentially is, NVIDIA in 2023. To some extent, it's only a component provider. It doesn't have any moat. There's a number of competitors that could take them out. The next inference or instance of NVIDIA's chips could be a different supplier of memory. So Micron stock could go down 80% in a day if NVIDIA says, hey, we're done with Micron, or we're just not willing to give them all this business anymore. We're going to diversify our stack. Micron will implode. So again, for us as investors, again, we have some of this. It's in our, we own SOX. It's in there. It's in, we own Broadcom, which is another supplier to NVIDIA. But it doesn't fit our framework of what we're looking to do. What we're looking to do is invest in companies that have a business model that is going to maintain and grow over the next 10 years. Micron is a supplier for another business, and their business completely depends on the contracts that they get, and those contracts should be cut off tomorrow. Okay, so we just want to be careful when we look at a company like this. A more important story is Meta. Okay, so here's a sample of a company that has maintained consistency. So what the red box shows is the earnings going back to 2017. 76% growth, 22% growth, 8% growth, 23, 35. 2022 was obviously the terrible year for everybody, down 18%, but then 54% growth, 39, 22, 30, 31. They are averaging that 20% growth that we're looking for. They're trading at 14.6 times earnings. They are trading at a 30% discount to the market. A company that grows earnings at 20% a year consistently with a balance sheet that's incredible, that has a massive install base, right? Millions and millions of active users on their systems, trading at a 30% discount to the overall market. Incredible, incredible opportunity. And everybody is discounting that Mark Zuckerberg is going to make a mistake. And he's made some mistakes in the past, but we don't believe that his investment in AI is a mistake. And we believe that Meta is in a prime position to grow significantly over the next 10 years. And in the last month, it's up 11%. So as Micron's getting hammered, Facebook's going up. And it's because the market got very focused on this earnings pop that Micron had on an NVIDIA story, but it's just a component supplier. And at the end of the day, Meta is a diversified business with millions of active users that can roll out all types of services to that install base. And now they're rolling out AI compute to the enterprise side because they have the capacity in the data center. So they're using compute. They have some excess capacity. They're going to sell that excess capacity to enterprises, and they have an open source model. They're fitting exactly in the story that we think is the true value in this AI build out. And again, it's being rewarded. And going back to our framework, this is why, even though we saw a slight underperformance year to date, we saw this massive outperformance the last 8 days, 9 days, because the market is turning. And the stuff that we think is the most stable parts of this AI build out are finally starting to see some light. And that's Amazon, and that's Meta, and that's Google, and that's NVIDIA. And we think those companies will continue to power forward. And that's why we're very confident as we go through the rest of the year. And we're extremely confident as we go through the next 10 years, because we are not making decisions based on momentum or emotion. We're basing it on companies that have proven without a shadow of a doubt that they can grow their earnings 10 to 20% year after year after year. And the management, in our opinion, is taking the right steps forward to innovating and implementing automation and intelligence. And that combination will do incredible things. And it will not be relevant what the consumer is doing. And it won't be relevant what interest rates are doing or what oil prices are doing. And that's how we want to invest. And we think that that's the winning hand. So in summary, oh, we got the Jesus picture. I didn't meant the Jesus picture to be here on this last one, but hey, that's all right. I guess Jesus wanted to be with us today. So concerns about the economy are justified, 100%. Weakness in labor, weakness in housing, weakness in the job market, especially for college graduates. I would be very concerned if I was graduating from college trying to find a job, because you're not going to. It's going to be a very difficult market. So definitely concerned about the economy, definitely concerns about the society. It is a scary but very exciting time in technological innovation. It is the biggest leap forward in technological innovation that we've seen in our lifetime. And it is going to change the entire world. And as investors, we want to be front row center for the biggest players in that change. And that's where we're going to be rewarded. So, again, the next 10 years is about companies that are going to optimize earnings and leverage this automation. And large American corporations are going to be the ones to do it. More than small, more than medium size, going to be large, and Americans more than foreign. So American exceptionalism, and that's where we're invested. And we think that's the winning hand. So at the end of the day, today, happy 250 years. I wrote that note in my email. I encourage, if anybody hadn't read that, I'd love for you to read it because it is really, I thought I was able to articulate my feelings pretty well there, which is, we're the greatest country in the world. We were built on individuals that pushed forward. And I try to do that every day. And I do that for you because I care about each and every one of your outcomes. And I care that you have the retirement that you deserve. And we think too many investors are going to be caught flat-footed when the inevitable black swan events happen. They will happen. Even within the AI system, there are going to be ebbs and flows. And that's why we try to maintain this framework of consistency in earnings and risk management. And that is going to be the savior for our clients as we inevitably hit the next bump in the road. But hopefully that bump isn't now. Hopefully it's not in the next 12 months, 18 months. I don't foresee it. But then again, you never do. So again, happy 250 years to all of us Americans. Thank you for spending the time today. I very much look forward to meeting all of you on Zoom in the coming weeks. Have a great day.